I want to say thank you for a little bit of your time. And now we're going to get to the most exciting part with my good friend, Richard Robinette, talking all about securities regulation.
All right. Take your eyelids open because we're going to get into the nitty gritty on
Securities regulation.
the things that you need to know when you're putting together these deals. Make sure that you don't get into trouble. I'm going to ask my video friend here to just put me up on the slides. I got a bajillion slides that are going to be going quick. I don't know if you can picture any of that stuff, but if not, just keep it on the slides and we're going to roll through this as energetically as I can. All right. I'm going to start off real basic with just simply what is a security. And one of the things that I run into time and time again is people are putting deals together and they're going out and they're shaking hands and kissing babies and raising money, and they don't even realize they're selling securities. And that can be a big problem because there are regulations around selling securities. So it's important to know what you're getting into. And the Congress, I think, did a really, really good job of making this absolutely clear exactly what a security is. Okay, I'm lying. They did a terrible job and they totally made the waters muddy, and nobody after this was published knew what a security was. And it took many, many years until we actually ended up in the Supreme Court in a case called SEC versus W.J. Howie, where they finally went through all this stuff and gave us a pretty simple, straightforward, easy to understand definition of what is a security. So a security is this, they said. It is an investment of money into a common enterprise with an expectation of profits from the efforts of others. A 4-factor test, you got to hit all 4 if you do what you're dealing with security. If you are offering it to someone and they are paying money for it, you are selling securities, and all these regulations come down on. Now, an even easier way to think about this is an intangible passive investment. If you are offering someone an intangible passive investment, I'm saying we're not talking about gold bars, something physical, intangible, like a business opportunity, a loan, a stock in your business, or a real estate investment, not the real estate itself, but the investment into it. That is an intangible passive investment. You are most likely dealing in securities. So what kinds of things make up securities? Well, I mean, there's kind of the obvious ones like stocks and bonds, annuities, oil and gas royalties, notes, LLC membership interest. Again, just see the theme here, intangible passive investments, as opposed to houses, apartments, commercial buildings, fancy cars, fine art, gold bars. These physical things that have value in and of themselves are not securities. And then there's the tricky one that appeared about 10 years ago, and that's cryptocurrency, NFTs, things like that. And frankly, the jury is still out on whether cryptocurrency is a security. The SEC is trying really hard to shoehorn it into securities. A lot of people disagree. I disagree. I think crypto kind of looks more like a commodity than a security because the return on your investment is not so much from the efforts of others, like the Howey test says. It's from the value of the actual cryptocurrency itself, maybe its utility in making exchanges, maybe because it's got a cool picture of an ape attached and everyone likes apes. I don't know, but jury's out. Probably where we'll end up is that certain cryptocurrencies or NFTs are securities and certain ones aren't. We'll see how things play out in the future, but the SEC is really fighting hard to fit them all under securities regulations. Okay, so I'm going to give just kind of a diagram of a basic investment scheme. So we have here an investment. This might be a business. This might be a piece of real estate. It might be a stack of notes. Maybe it's bad credit card debt that people invest in. Doesn't matter. It's an investment. And we're going to have a business entity that we form in order to fund this investment. Most common is going to be an LLC, could be a corporation, could be a limited partnership. Doesn't really matter. I'm going to stick with LLC. So the LLC is going to own this investment. Now, our LLC has 2 groups of parties involved. On one side, we have a manager. This could be a management entity. It could be an individual. It could be a group of individuals. And on the other side, we have members. And members, when we're talking about LLCs, just means owners. If it was a corporation, we'd call them shareholders or stockholders. If it was a limited partnership, we'd call them limited partners. Same concept. The manager or the general partner or the board of directors, whatever, exercises control over this entity. The members, on the other hand, just put in their money and really don't do anything. And then that money is used by the LLC to invest in the business, buy the real estate, whatever it's going to do. And then we all hope that it's going to spit off a whole lot of money for everybody. Okay, so this is kind of the basic structure. So is this a securities offering? Well, let's apply the Howey test. All right, so we go through our 4 factors here. Is there an investment of money? Sure is, right there, into a common enterprise with an expectation of profits off of what? The efforts of others. So the manager is going to give effort in this common enterprise, the LLC. It's going to spin off profits for the members who made that initial investment of money. Bada bing, bada boom. This is a securities offering that has been done. So what? Why do we care? Well, for a long time, nobody really did care. And then world-changing event happened, 1929. Stock market crashed. The stocks went to nothing. People lost tons and tons of money. We had unemployment and bread lines and the Dust Bowl, poverty, people dying in the streets. And worst of all, every 8th grader from that point on was forced to read The Grapes of Wrath crisis. The world needs a hero. And instead of getting a hero, they got these guys. And our esteemed colleagues and the members in the halls of Congress had not one, but 2 knee-jerk reactions to this. One, they gave us the Securities Act of 1933 and the Securities Exchange Act of 1934. Generally, Securities Act is about selling securities for the first time, and the Securities Exchange Act is about selling them again, because for some reason, we need 2 different sets of rules. Okay, the sum and substance of these 2 rules is this. Selling securities is illegal, except when it's not. So what they did here is they came up with this idea of securities registration. So they classic licensing scheme. They take away your right to do something and then sell it back to you. The securities registration works like this. All securities offered in the US have to be registered with the SEC and state regulators, or they have to qualify for an exception. And what we're going to find out is that the exemptions or the exceptions they swallow the rule. So what are our exemptions? Well, Securities Act has a section 4A2. This is one of our exemptions. It says you don't have to register as long as this transaction does not involve any public offer. And I remember, growing up and learning language, and I was maybe 4 years old, and I heard this word, the public, and I asked my mom, what's the public? And she said, well, the public is all of us. It's people. Okay, so I look at this and I say, okay, you can sell securities and not register them as long as you don't sell them to people. Awesome. This, of course, can't clearly be what they mean, but we're not given a whole lot of guidance on what they do mean. And then we had some court cases come down that really contort into weird definitions of the public. For instance, there's a case called Purina, in which a company selling its own stock to its own employees was considered a public offer. And that's a surprising result to me. That came down. So we need obviously a little more guidance. Enter the SEC. The SEC has given us a series of regulations, rules that we can follow to demonstrate that we are exempt from registering. So one of these regulations is Regulation D. And what Regulation D does is it provides a safe harbor. It says, if you follow these rules, you will not be deemed to have offered your securities publicly. Within Regulation D, there's a set of rules that you can pick and choose from. The big ones are 506B and 506C that I'm going to talk about. There's also what's called Rule 504. I'm not going to spend any time on 504, but in a nutshell, 504 lets you raise up to $10 million as long as you conform to state law in the states you're raising the money. Now, some states won't let you raise $10 million. They might be restricted to 5 or whatever. So you're stuck dealing with individual state regulations if you use 504. That's all I'm going to say about that. Hardly anyone uses it anyway. We've also got Regulation CF. This is for raising money online. Regulation A, which is kind of a quasi-public offering. Regulation S, which is raising money from non-US persons outside the country. So in a nutshell there, the SEC is not terribly concerned about protecting people outside the United States who are not Americans. So Regulation S is pretty deferential and lets you raise money overseas, as much as you want from whoever you want. As long as you're complying with the laws over wherever they are, you're good. And there's a number of other regulations in here too, a whole alphabet soup of regulations for us to deal with in trying to avoid any kind of regulatory issues when selling our securities without registering them. And by the way, you probably don't want to register your securities, especially for smaller deals. The process is super long. It's super expensive. It takes a ridiculous amount of resources. And if you're only raising $5 or $10 million because you want to buy an apartment complex, you're wasting your time trying to go public. You're going to be in the world of exemptions. So let me get started with the vast majority of these deals are happening. So $3 trillion, trillion with a T, was raised in unregistered offerings in 2017. Well, 2017 is just the most recent year I have numbers for. I'm sure it's much bigger now. 60% of that was under regulation. Now, to give you an idea of the scale of this is $1.85 trillion. That is about 60 times the amount of capital raised in initial public offerings the same year. So this just dwarfs registered offer. And the median raise under Regulation D, $2 million. So a lot of small deals are in that pile there. So let's get into the rules of Regulation D. 506C is the first one I'll talk about. 506C allows you to raise an unlimited amount of money from an unlimited number of accredited, quote unquote, accredited investors. And I'll get into the definition of accredited for now. Just understand these are rich people. These are well-to-do people, high income or high net worth individuals or large business entities. 506C requires that you take reasonable steps to verify that your investors are accredited. So you need a letter from an attorney or a CPA. There are online accredited investor verification services. You can verify an investor for $150 or so, but you have to demonstrate that you've taken reasonable steps to make sure people who say they're accredited are actually accredited. A recent change that was made, and I'm just going to pepper recent changes throughout this presentation, things that have changed in the last 1 to 3 years. So basically changes since 2020, I'm going to throw into here and kind of flag them for you. A lot of the information on the internet still, is old or expired. So you might see different numbers, and that's because these regulations have changed very recently. So a recent change in 506C is that once you've done that reasonable step and you've gotten that verification, that letter from a CPA or whatever, you can rely on that. As long as you don't have contrary information, you can rely on that verification for the next 5 years before having to go through that step again. So that's kind of a cool change that makes 506C a little easier. The bad news about 506C, no unaccredited investors are allowed. If someone does not meet that threshold to be accredited, you can't let them in your deal at all. Sorry, goodbye. But on the bright side, general solicitation is allowed. So you can get on Facebook or Instagram, you can put up billboards, you can run radio ads, you can shout it from the rooftops, advertise your deal, and it still won't be considered a public offering. And that's kind of cool. 506B is another rule under Regulation D, and it's very similar. It's got a couple changes. So again, we can raise an unlimited amount of money. And again, from an unlimited number of accredited investors. And I can take their word for it. If someone tells me they're accredited because their income is over $200,000 a year, I can take it to the bank as long as I don't know any better. And I can include up to 35 unaccredited investors as long as they are sophisticated. And we'll talk about what makes somebody sophisticated in just a little bit. Like 35 in my deal. And a recent change that they made was that it's not just 35 total, it's 35 in any 90-day period. So there's actually the possibility, the way the rule's written, to have more than 35 unaccredited investors if your deal is open longer than 90 days. There are investment disclosures required, especially if you have unaccredited investors in your deal. Those come in the form of a PPM. PPM is kind of like a prospectus. You might have bought a mutual fund and gotten a prospectus. PPM is the same basic document, disclosure document. Here's all the risk factors. Here's information about the deal. Here's the structure. Here's the management, things that you ought to know before you put your hard-earned cash into a deal. Those will go into PPM. And a recent change, if you have an operating business that was going to raise money using 506B, before you would have to supply to your unaccredited investors audited financials if your deal was over $2 million. They've since raised that. So now we don't have to have our financials audited until our offering amount is at least $20 million. And under $20 million, we can do unaudited financials. Now, a lot of 506B deals are just brand spanking new companies. There's no financials to provide because the business hasn't done anything. It hasn't been capitalized yet. But operating businesses, that'll come along. And the bugaboo with 506B is general solicitation is not allowed. You cannot do your Instagram posts and your Facebook posts and shouting it from the rooftops. You have to stay within your own private network of investors. And we're not given a lot of guidance on how we're supposed to do this, but the SEC has recommended, this is not a rule, but it's a recommendation that you have a pre-existing substantive relationship with your investors. And I'll get into the finer things of what does pre-existing and what does substantive mean. But in a nutshell, your investors are people you already know, you already have a relationship with before you start soliciting their investment into this offering. So let's define some of these terms. And I'll start with accredited. So are you accredited? Well, for the last 2 years, was your income at least $200,000 a year or $300,000 a year combined with your spouse? And then a recent change is they added or your spousal equivalent. So those of y'all that are shacking up or, not married, but living together and acting as if you were spouses, you can actually combine your income as if you were spouses. And that's a spousal equivalent. I've got a great idea for anyone that wants to join my scheme to raise money from unaccredited investors. Sorry, my joke doesn't hit if it's not on the screen. All right. I don't know if having more than one spousal equivalent is going to work, but I'm hoping this guy tries it. Now, maybe your income's not that that high. Can you still be accredited? Yes, you can. If your net worth with your spouse or spousal equivalent or harem is over $1 million, then you are accredited. By the way, when you're accredited, there's no application or anything that you fill out to be accredited. It's just automatic. You are accredited if you meet these criteria. So net worth over $1 million. Now, this does not include your home. Positive equity in your house does not count towards your net worth for purposes of telling whether you're accredited. Negative equity in your house, if your house is upside down, that does count against you. But you could have a $10 million house free and clear and not be accredited because that $10 million equity does not count in making this calculation. And in a recent change, people who maybe don't meet these financial requirements but have financial credentials like a Series 7 can be accredited simply because they have a license. And that's pretty cool. Ironically, being a full-time securities attorney who drafts these offerings day in and day out is not good enough to make you accredited. And that really ticks me off, frankly, but it is what it is. And then finally, are you a director, executive officer, general partner? Are you the boss of the entity issuing the securities? And if so, for purposes of that offering, you are considered accredited. Entities can also be accredited. So an LLC or a partnership can be accredited. First of all, if all the owners of an entity are themselves accredited, then the entity itself is accredited. So I've got a high net worth. My buddy's got a high net worth. We form an LLC together. That LLC is automatically accredited. Also, entities that have assets in excess of $5 million, as long as they weren't formed for the purpose of doing this offering, of investing in this offering. If we have $5 million in assets or more, we are accredited. And there's some others. Certain banks are accredited, private business development companies, family clients, knowledgeable employees of issuers, and there's rules and kind of nitpicky stuff around this that I'm not going to get into here. But know that there are other ways for entities to be accredited. All right. Well, if you're not accredited, you can't be in a 506C offering. You could be in a 506B offering, though, as long as you're sophisticated. So again, what does it mean to be sophisticated? Well, sophisticated simply means you have knowledge and experience in financial and business matters such that you're capable of evaluating the merits and risks of the investment. So in a nutshell, you are smart enough to know what you're getting yourself into. Or you have a purchaser representative who is knowledgeable and experienced such that they know what you're getting into. And you can rely on this purchaser representative if you yourself don't have that knowledge and experience. Now, what's a purchaser representative? It's simply another person who's not involved with or not a major player in the entity doing the offering, who basically loans you their sophistication so that you can invest. So that's sophisticated. That is a requirement of all your unaccredited investors under 506B. Now, 506B, like I said, does not allow public solicitation. And our recommendation from the SEC is that we have a pre-existing substantive relationship with any investor we let in the deal, accredited or unaccredited. Anybody we let in the deal, we need to establish this relationship before commencing the offering. So what is a pre-existing substantive relationship? Well, pre-existing is very simple. Pre-existing means it's prior to the commencement of the offer. And the only kind of tricky thing there is commencing the offering might start much earlier than you think. So as soon as you are soliciting interest or talking to anyone about your deal in such a way that it conditions the market to now or eventually buy your securities, you have commenced the offering. And that relationship to be pre-existing needs to come before, and it could be a second before. There's no waiting period, but it has to come before you are deemed to have commenced your offer. And then what is substantive? Now, substantive doesn't mean I know him like really well because our kids are in ballet together and he comes over to my house and we barbecue and we go fishing. Substantive has to do with your understanding of their situation financially. So you have enough information to evaluate, and you do actually evaluate their financial circumstances and sophistication to determine whether they are, or your offering is suitable for them to invest in. That's Regulation D. And again, vast majority of offerings are going to come under Regulation D. Like I said, 60% of private offerings under Regulation D. So only 40% are all these other exemptions that we're going to talk about. Fairly new kid on the block, Regulation Crowdfunding. And this one actually has not been terribly useful until just recently when they made some changes to it. You can raise up to $5 million online from the crowd. And this is a recent change. It was increased from 1.07, and 1.07 was so low it wasn't worth anyone's damn time to do it. $5 million little more appealing. I kind of wish they would raise it even more, but that's where we're at. And there's no limit on the number of unaccredited investors you can have, but there is a limit on how much your unaccredited investors can invest. And that limit's determined based on their income and net worth. And there's a couple thresholds that is a little bit complicated to get into, but just know that they're going to be limited to either 5 or 10% of their net worth or income to invest in your deal. And then your interest in a regulation crowdfunding offering have to be sold through a registered crowdfunding portal or through a broker dealer. FINRA, which is a regulatory body, is going to get involved, and they have approved a certain number of websites that are allowed to do these crowdfunding offerings. And that's the only place sales are going to happen. So they've got a website, you go to the website, you see the deal, you invest. You can't do it anywhere else. You can't build your own website unless you register it with FINRA, or if you sell your interest through a broker dealer, which we got a conversation with a broker dealer coming up in just a little bit. That's going to be amazing. And your offering, your documents must be submitted to the SEC. They don't review it. They don't do anything with it. They don't approve it or qualify it, but you still have to give it to them. And so that's one of the places where regulation crowdfunding differs a little bit from Regulation D. And then there are limitations on what you can say about your offering publicly outside of that crowdfunding portal. So the bulk of your marketing efforts on a regulation crowdfunding offering is to get people to your portal. And then once you get them to the portal, then on the portal, you can advertise to them, communicate with them, tell them all about the great things you're doing. Other restrictions, U.S. issuers only. Foreign issuers cannot come to the United States and do a regulation crowdfunding offer. No investment companies or funds of funds. So these have to be businesses that are making direct investments, non-investments into other investments. A recent change, however, they allow certain what's called special purpose vehicles called crowdfunding vehicles. It's a new definition they created. Crowdfunding vehicles actually can invest, and crowdfunding vehicles are kind of like a fund of funds. They're basically a fund that is made to invest in a specific crowdfunding offering. And that crowdfunding vehicle actually becomes a co-issuer with the issuer. Seems a little silly, frankly, but new thing that they just gave us. No SPACs. SPAC is a special purpose acquisition company. It's basically a company that has no business purpose other than to maybe sort of one day acquire another company, but they don't have anything targeted. No SPACs allowed in regulation crowdfunding. And I'm going to jump into Regulation A. And Regulation A is a quasi-public offering. It kind of starts to resemble a registered offering, but with a lesser disclosure document, lesser reporting requirements. It's kind of somewhere in between a private and a public offering, if you think about it. Often you'll hear Regulation A referred to as the mini IPO. It's also called Regulation A+. Plus just refers to the fact that several years ago, they made some changes to it that made it more useful, more appealing. Regulation A was very difficult before until Regulation A+. It's not an official name. It's just kind of what people call it since the change. And there have been even more recent changes. And so some people now call it Regulation A++, which, a few more changes in the future. It's going to get a little bit ridiculous, but that's okay. Or Reg A for short, not to be confused with Reg A. I can hear you all laughing through the computer. Regulation A has two tiers, Tier 1 and Tier 2. Tier 1 is basically useless. It requires you to comply with 50 states' laws all at the same time, and that's generally impossible. It has limits on how much you can raise. If you're doing Reg A, 99% chance you're doing Tier 2, so that's all I'm going to talk about. Under Regulation A Tier 2, you can raise up to $75 million. So it's not unlimited like Reg D, but it's still a pretty high limit. So most, for instance, apartment deals or whatever, you're going to come in under this amount. So you could do them under Reg A. Now, this is a recent change. It was 50 million until just recently. It's now 75. Anyone can invest in a Reg A offering. There's no requirement of being accredited. There's no nothing. Anyone and everyone can throw their money in one of these deals. Now, like Regulation CF, if you're not accredited, there are limits on how much you can put into Regulation A deals, but you're allowed to at least put something. And Regulation A, like I said, it's quasi-public. General solicitation is allowed. So you can go out and you can advertise. So this is kind of the first opportunity without registering to be able to go out and publicly advertise to unaccredited investors and let them in your deal. And that is a game changer, especially for people who have large social media followings of unaccredited investors. You can pitch your deals to the general public. Now, downside generally takes longer to put together and get your offering to the public than Reg D. There are more extensive disclosures. So what's called a Form 1A, which is a very, very long, complicated document, very difficult to draft. Definitely don't want to do it yourself. You need a securities attorney. You need one for all of these, but especially here. It requires that your offering be qualified with the SEC. So we're actually going to draft everything. We're going to submit it to the SEC, and then they might have some things to say about it. And they'll send us letters back saying what they want changed, what they don't like, what they have questions about. And there's generally a few months of back and forth with the SEC until they finally throw up their hands and say, okay, we will let you do your offering. Now, qualification is not registration and it's not approval. So when they say you're qualified, basically all they're saying is we're not going to get in your way and stop you from doing this. But we're also not going to tell you that you've complied with everything under the rule and that this exemption is actually available to you. So qualification is kind of a hurdle, but it doesn't actually give us any positive approval from the SEC to go forward. Reg A offerings require audited financials, no matter. And even if it's a brand new company with no operations and no nothing, there's still going to be financials that say there's nothing here. You paid an attorney $25,000, which is owed back to the issuer that came out of pocket and nothing else. And then we're going to have an audit of that. And we're going to have a long CPA letter, explaining that there's no money in the company. Okay, so who is this for? Like I said, people who need a large amount of capital, up to $75 million. People who are good at marketing and they have a large public following of unaccredited investors. If you've got a large following of accredited investors, just do Reg D. It's a lot easier. But if you need those unaccredited investors, you need those lower dollar investors, Reg A is your vehicle. Where are your investors? They're on Facebook, they're on Reddit, they're all over social media. If your social media game is awesome and you've got a ton of followers, this is a thing for you. Maybe you're a Kardashian, maybe you're a Grant Cardone. The Regulation A is a great vehicle for people like this. And even maybe like this guy who's got a bajillion followers just for pointing out obvious stuff. If this guy wanted to sell securities, Reg A might work for him because he's got this large audience of Joe Everyman. Now, there are other restrictions on Reg A that you need to be aware of. One, it's only for US or Canadian issuers. So Reg CF was only US. Reg A also allows Canadians to come in. The principal place of business must be in the US or in Canada. Again, no SPACs, no special purpose acquisition companies. So your company has to have an actual business plan with an actual thing it's going to invest in. And no funds of funds. So you can't raise money to invest into other securities. No fractional interest in oil and gas. You're not going to see oil and gas deals on Reg A offerings. Reg A is going to require you to build a bigger team than some of these other offerings. There's a lot of players that you're going to have to get involved, professional players. They cost a lot of money, and you're just going to have to foot it up front, starting with your securities attorney. You've got to have a securities attorney on this. You cannot DIY Reg A offering. And the reason you're going to need a broker dealer is there are 4 quote unquote problem states. Now, this is an improvement. There used to be 7 or 8. We've gotten it down to 4, but we still got 4 problem states that, for whatever reason, require you to have a broker dealer or be a broker, do a regulation offering in their state. Now, some issuers go out and they just register as a broker individually in these states and they get around it. One problem right now is that Florida is not registering anybody. Don't know why. Nobody can get through. If you want to raise money in Reg A in Florida, you're going to have a broker deal. You're going to need an auditor for those audited financials. You're going to need a transfer agent. What a transfer agent does is they handle the trading of shares or units in your transaction, which you're going to need because if you think about a Regulation A offering, most of your investors are going to be unaccredited. They're going to be low dollar. So imagine if you're raising $75 million and your average investor is 10 grand, that's a lot of investors to deal with. You need someone with the infrastructure to handle that. You'll also need a compliance service for your securities filings. Every state has what's called a blue sky filing that's required. And the filing requirements for Reg A in particular are pretty tricky. Some states want you to predict the future. They want you to go to them at least 3 weeks before you sell anything and tell them exactly how much you're going to sell. How you're supposed to know this, I don't know. But you really need to have a compliance service that deals with blue sky filings for Reg A day in and day out to handle these for you. Don't try them yourself. You'll need an offering platform to hold your offering documents and to accept your investors. So you don't want to be doing this by fax and paper. It's going to be too much to handle. The offering platforms are just websites that host your offering and host your documents and let people access the information they need and make their investment. Finally, you're going to need a securities escrow. Now, this is not like an escrow like when you buy a house and you have a title and escrow company. This is a bank that provides a specific account for escrowing securities money. Now, these are very expensive accounts. The fees in the accounts can run you like $4,000, $5,000, but you're going to need this to hold your investor money until you have raised enough to quote unquote break impounds. That means you've raised enough to meet the threshold to actually start operating the business that you're funding with your offering. So that's in a nutshell, Reg D, Reg CF, Reg A. Those are the biggies that you're going to rely on if you're not registering your offerings. And I'm going to fly right into other recent changes in our security rules. And these are kind of more general, not specifically in each one. One is the SEC has given us broader testing the waters rules. And what that means is that we've got more opportunity than we had before to go out to the public and gauge investor interest before we start an offering. So you can solicit interest, and this is brand new. This is great. You can go out and solicit interest of investors before even deciding which exemption your offering is going to rely on. And then if you know you're going to rely on Regulation A or Regulation CF, they have their own testing the waters rules that you can comply with and kind of start seeing, okay, does my deal look good? Does it look like people will invest before you spend the resources putting all your documents and everything together? The testing the waters language, there is some specific language, word for word language you need to include in all your solicitations. Those are in the rules. Your attorney can give that to you. Now, one thing to be aware of is that when I talked about, for instance, having a pre-existing substantive relationship with your investors, for instance, under 506B, we need to be aware of when our offering is commenced. And one of the things to be aware of is that once you start soliciting interest, that is considered commencing your offer. And so your pre-existing needs to come before that date, not simply before you put out a PPN. Another gift they gave us, new integration rules. So integration is an idea where the SEC will look at an issuer who's maybe doing multiple offerings. And the reason they're doing multiple offerings is because if they were all one big offering, their offering wouldn't comply with the rules or the limitations they're under. And the problem is the SEC will look at this and be like, well, you're just doing this to get around the rules. We are going to integrate it and treat it as if it was one big offering. Congratulations, you've violated securities laws and we're suing you now. So recently they gave us new integration rules, and they actually, one of the most important things they gave us was a 30-day safe harbor. And in a nutshell, as long as you have 30 days between your offerings, in other words, one offering shuts down, 30 days passes, and another offering begins, as long as you're following the rules in each of those respective offerings, they will not integrate them. And that gives a lot of mental relief, especially for issuers that may be doing multiple deals. So that's a really good change. And then one more, and this is even more recent change, this has really happened this year, is the SEC has taken on an increased focus on enforcement. They are getting aggressive with enforcement and finding people that are not following these rules and punishing us. So let's talk about how risky is it to just simply ignore securities rules. And this happens all the time. People go, oh, my deal's not very big, so I can just fly under the radar. You're not flying under the radar. You are low-hanging fruit. All my investors are friends and family. There is no friends and family exception in the securities rules in the United States. Certain parts of Canada have it. The United States does not. Your friends and family are the public, and you need to follow the rules regarding soliciting the public. And people try other things, other cute things. Oh, we've got 38 investors. We're going to make them all managing members so that they're not passive, and therefore it's not a securities offering. The SEC sees right through that. There aren't 35 jobs to do in your offering where they would all qualify as having some active role. Just don't get cute. Just follow the rules. Just follow the rules. So what happens if we don't? Well, the SEC last year levied $3.8 billion with a B, in fines. But that's been updated. This year, and the year's not even over, but this year, and this press release just came out 2 weeks ago, they have gotten orders for $6.4 billion. So judgments against people violating securities rules are up 67% just this year. That's huge. This is scary. They are not playing here. They're taking action against small operators as well as large corporations. It's not just Ripple who's getting sued by the SEC. It's the little guys too. They're taking action against issuers even when there haven't been investor losses. One of the things that you might hear securities attorneys say is, oh, you don't even need to follow the rules unless someone loses money. And then when someone loses money, you should have followed the rules. It's not true. Simply breaking the rules is enough to get them to come after you, and your investors might be fined. Penalties for violating the rules can include fines, disgorgement, which means giving all the money back. Of course, you can't give it back because you spent it on the investment, which means you're going bankrupt. And you can be permanently banned from raising capital, either in individual states or nationwide. And then finally, willful violations are punishable by imprisonment. You can literally spend 2 decades in prison for willfully violating securities rules. Just don't do it. Hire a securities attorney, follow their advice, follow the rules, do it right.